But time now to take it across to Mr. Rajan Venkatesan. He's, of course, the CFO at LatentView Analytics, joining us on the show. Hi, Rajan. Good to be speaking with you. Thanks so much for making time and speaking with us. But I was just going through your commentary, and earlier you had guided that Q1 specifically will see a growth of almost 5% on a sequential basis. Actually, you've delivered 4% growth, and even the profitability has declined. What went amiss versus your expectation, and is it expected to be a drag going forward as well?
So thanks for having us on the show. As always, good to be here. In terms of the Q1 performance, you're right. I think our initial expectation or guidance was to sort of deliver a growth which was in the 5 to 6% sort of range. But then what transpired in Q1 was some of the large deals that we were hoping to sign took a little more time. I think it was more a timing sort of an effect. So we were not able to realize the full potential or the full revenue from some of these deals that we were able to sign on. And we were able to book revenues only for a month as opposed to booking them for a quarter, right? So I would say it's essentially a timing issue. Definitely not something that will be a drag in the following quarters. In terms of the profitability, I think one of the things that we'd also done was we had guided the market that Q1 was likely to have a little bit of compressed margins because one, we typically roll out increments effective 1st April, which is what we did this year as well. So there were increments in the range of close to about 10% for all of our India folks, and then for our overseas folks there were increments in the range of 5%. So that kicked in with effect from 1st April. That was supposed to have some impact on the margins. The second factor that is also important to note is Q1 typically is when we also book some of the visa-related costs for the H1B application. And so in some sense it's a cyclical cost that we incur in Q1, and these two were supposed to have an impact on margins, and that's exactly the way it transpired. Now, if you were to just break down the 2% odd compression in the margins, 1.2 can be attributed to wage hikes, and the remaining 0.8 could be attributed to the cyclical visa cost, which should not occur going forward, right? So as the revenue expands, we will be able to absorb some of these costs that were there in Q1, and therefore you should see an improvement in EBITDA going forward.
So the order where you were delayed in terms of translation, will that be captured in coming quarter, likely to accelerate in the next 6 months?
So I would say for the next couple of quarters as well, while there was a timing delay, right? What we are continuing to see, and this has been a trend over the last, I would say 4 to 6 quarters, is deals are taking longer periods of time to sign on, right? So and therefore there is a longer sales cycle that we are witnessing. I don't think we've completely seen a reversal in that particular trend. Having said that, I would say there are a couple of sectors that are definitely looking promising. BFSI for one is beginning to show some strength. I mean, it was for the whole of last year for us, BFSI was lagging behind, but towards the end of last fiscal and also right through this year, we've been seeing positive momentum in the BFSI vertical. Secondly, with the acquisition of Decision Point, you will also see continued strength in the consumer vertical for us, which we hope should get us should be close to about 20% of our overall revenues by the end of this fiscal. So both these verticals, we would expect them to fire at a rate that is much faster than what we've witnessed historically. But the deal cycles or the sales cycles continue to be slow. I think that trend has not changed.
Now, in order to accelerate on the top line, could you be compromising on your margins? When I say margins, 20% is the new base. Could it go back to, let's say, what you had 4 or 5 quarters ago where you were sub 20?
Not really. I don't think those are levels that we would go back to, because I think at that point in time, I think there was disproportionate level of investments on the sales and marketing side, right? Because we really wanted to, on the back of the IPO, one of the promises that we've made is we will invest in building the sales and business development muscle in the US and Europe. We've had some learnings from some of those investments that we've did, and I think at this point in time we are fairly comfortable that the level of investment that we are carrying today on the S&M side are sufficient for us to get to even 110 million sort of a revenue range So you will not see incremental spends on S&M. Therefore, we believe that any expansion in revenue, any sort of bump in revenue should result in operating leverage, and therefore EBITDA margin should continue to improve through the course of the year.
Net, when you're saying BFS is looking up, but there has been delay in deal signings, I want to get a sense from you whether there is a risk to that 18% growth guidance, at least on the organic basis that you had talked about earlier, and margins 23% is something that you'll be able to attain for the full year?
Yeah. So at this point in time, we are fairly comfortable guiding that on an organic basis. This is without including the results of Decision Point, the company that we acquired. We'd be able to deliver a 16 to 18% revenue growth. So that's the range that we are setting out for ourselves. I think that's like the base case, right? If we do see, and we are expecting for deal flows to improve in this quarter and the following quarter, we should be able to better that 16 to 18% guidance. Right. Your second question was on the EBITDA margins. We do expect that by Q3 we should be back at those 23% odd levels, and should be able to ideally deliver a full year EBITDA in the range of. At this point in time, we want to be a little conservative in guiding. We want to, on a full year basis, we should be between 22 to 23. But if deal flows improve, we can actually up that number as well for the full year.
Clarify, Rajan, you're opening a downside on both these because earlier the numbers I have is 18 and 23. Now you're talking about 16 to 18 and 20 to 23. Are you just expanding the range a bit more in this quarter?
No. So the revenue guidance is 16 to 18%. There you're right. The EBITDA number that I mentioned was 22 to 23% on a full year basis, not 20 to 23.
Okay, so I hear you. 22 to 23% is what the range you are targeting for the margins. Your Decision Point acquisition that you were talking about, just wanted a clarity whether it will be EPS accretive from year one itself, and any other further acquisition in the pipeline that you're watching out for, maybe in APAC or Europe, which has been the areas that you've been trying to deepen your presence into.
So the Decision Point acquisition for sure will be EBITDA accretive for us because their margin profile is significantly better, or I would say because they are also a little subscale. So their EBITDA profile is definitely better, and so it will improve the EBITDA margin of the consolidated business. However, at an EPS level, we are currently in the process of doing an extensive purchase price allocation exercise, and we will need to really understand what will be the impact of any amortization of intangibles that would occur as a result of this acquisition. We do believe that maybe for year one it may not be EPS accretive, but definitely from year two onwards it should be EPS accretive. One, purely because the business continues to scale, and two, we will realize significant synergies both on the go-to-market side as well as some level of synergies on the cost side. So we believe those should kick in, and we should start seeing a positive EPS accretion for the consolidated enterprise.
Okay, Rajan, on that note, we'll let you go. Thanks so much for providing the clarity and candidly talking about your numbers. But for now, the market is pretty much sideways.